Well, everybody, I'm Cantonese Cat. Hey everybody, Cantonese Care here. I'm gonna do a little bit of a different video here for YouTube. I've been sharing some thoughts here on eggs. I figured I'll share it on YouTube here as well. It's gonna be a little bit awkward because I don't like to show my cat face, so I'm just gonna talk a little bit about my X post here. I have two posts I want to share with you. If you're not subscribed to me on X, please not subscribe. If you're not following me on X, whatever that means, please feel free to do that. I do have spend a lot of time here. I do post a lot, and so far it's growing. I have an account that I was a separate account that I've been growing for years. I've almost 20,000 followers, and I had to shut down that account because I clicked the wrong link and some scammer was able to post scam posts on my account, so I had to shut that down. And I refreshed this. This is a brand new account that's just started around July, but I really started migrating into it around September. And it's already gained back a lot of followers. So thank you so much for y'all's support. I'm just going to go straight into what I was going to talk about. You see, I post a lot here over and over again. And even, I basically just spent a lot of time there. I probably shouldn't, but I spent a lot of time there. A couple of days ago, I was at Danny's Patreon. I was looking into posts, and somebody asked a question about what we thought in terms of how the market makers behave and how money moves, what's going on behind the scene and all that. And I gave the best response I could. I don't know if you guys watched a Jim Cramer video. He was basically just talking about how slimy hedge funds are, and that if you're a hedge fund manager, you're supposed to play the game where you just basically just go out there, set false news. It doesn't have to be correct at all. You just go out there and just say a bunch of things to try to manipulate price to get you to be at a best position as much as possible. And that's completely legal. The SEC doesn't really know what's going on and all that. It's kind of fascinating, actually. So the whole idea is market makers are the ones that set prices. Really, they only have a few motives in manipulating prices a certain way. First of all, a lot of retail traders, especially since 2021 or so, a lot of people are just trying to buy options, calls, and puts. There are only really a few people who are really actually able to use option strategy to their benefit. The majority of people actually are not, because they're using these more as a gambling tool. They're looking at earnings, or they see momentum. They just want to be a part of it. They end up buying these short-dated calls and puts, and they just simply end up losing, because the whole financial instruments that's being designed with options, they're meant for you to lose, because the market makers can manipulate the price in the short term and make sure that the price goes up and down, and to cause max pain, so they would not have to pay for your options, and they would just expire worthless. That's what they want to do, right? Especially if you're a retail investor, there's no reason for them to want you to win. They just look at, oh, those are retail investors doing this, doing that. This is when the call expiration or the put expiration happens. We're just gonna mess with you and take that money away from you. Thank you very much for playing. They can do a lot of things, especially during low volume trading time. They can really manipulate based on maybe spreading fear, maybe spreading euphoria. There's always maybe some news here, and they can end up causing the market to get up or get down, which can cause the sentiment to be extremely euphoric or extremely horrific, depending on the way they want to do it, to swing prices certain ways, and to avoid having to pay retail traders for their leverage positions. They do this all the time, right? This is why short data options are considered gambling, and the casino always wins, right? There's a comment. I think somebody commented on my post too, basically saying that they've been working in the financial system for a very long time. In the 80s, they had somebody who's been around for a very long time, basically saying that if you buy short dated options, you're basically helping to make payments on some Wall Streeters yacht or something like that. That's basically what you're doing. So there are only a few people who can use this in a wise manner, and they're out there. Some of them do end up selling calls to try to make income. There are a lot of different, and you also I think it's okay to do long dated leaps and things like that. I think it's fine, because the market makers, they just can't manipulate it that much. but I'm a little bit more wary about doing short-term data options, things like that. Now, market makers also likely to have friends. They're not you and me, right? We're a retail investor. I'm a cat. You're people, but you're not. If you're listening to this, unless if you're like a fund manager who has like extremely powerful, you run like a multi-billion dollar fund, and you're trying to see what retail investors are like, you probably wouldn't be listening to me, by the way, right? Because I'm not that big. But if you're listening to me, you're probably retail, right? Market makers like to have friends who are not you or me, but somebody who's rich and somebody who's powerful. They likely have information behind the scenes ahead of time that we don't have access to, right? Even when it comes to war conflicts, even when it comes to like something that's real, right? Or COVID or something like that. Like they usually have some insider information that we do not, right? They're usually coming from the elites. They're usually coming from the rich and powerful. And they don't care about us. They just don't care about us. And that's fine. There's no reason for us to expect that they do, because we want to be realistic here, right? So all of these market manipulators, market makers that sets the price in terms of what stocks should be traded at, know people. And those people who know things behind the scene are going to let the market makers know ahead of time as well in terms of what's happening, right? So they're sharing this information behind the scenes, and there could be some news or some information that comes out to you as a retail investors, and quite often they're either falsified or they're just significantly delayed, right? And if you get delayed news, even if the news is completely valid, if you get it delayed, you're going to end up reacting to it too late, after the big move has already happened, right? And this way, they are able to really get you off sides. And what they're going to do is they're going to make sure that you lose your shares when you should be holding or buying. And they're going to make sure that you buy more shares when you should be selling them. This way, wealth gets transferred from retail traders and investors to rich and powerful, as the market makers and the powerful elites continue to help each other out. A lot of people focus on the Fed. I have some issues with people talking about the Fed all the time. If you're going to talk about the Fed, that's fine. It's a signal. It does tell you overall what the economy, the state economy is, whatever. It's like an official statement that's being released out to public. A lot of people are really trying to pay attention to it. A lot of algorithm is being trying to set close to that. I actually don't know whether or not the Fed is the signal to talk about the economy. I'm going to share with you a little bit as to what my thoughts are on that here on a separate post I'm going to talk about. I just don't know whether or not the Fed is like the thing, because honestly they have a dual mandate. They want to make sure that unemployment stays low, and they want to make sure that inflation also stays low, right? And they're going to use these blunt financial instruments, is what Jerome Powell calls it, to set rates a certain way, to make sure that we use either quantitative easing, quantitative tightening, to use these blunt financial instruments to try to set the tone of the economy, to allow it to not crash, so you don't get a bunch of unemployment, to allow it to not be overheated, so you can control inflation. The reality is this: they're going to try to do this, but really their one mandate is this: they want to make sure the economy doesn't crash. They want to make sure the financial system stays alive. And that's exactly what happened in the great financial crisis. Banks can't fail anymore, guys. Banks can't fail anymore. They're going to do whatever they can to keep this whole Ponzi going, and to allow this transfer of money from the retail traders and investors to market makers and powerful elites. They're going to continue this tradition going until they can't anymore. And there's no reason for them to want to stop, because it's been working. And as this continues to go on, you're going to have a lot of retail investors. They're just going to be so jaded. They're not going to want to participate in the market when they really should. And you're going to draw in a lot of people that when things are really euphoric, a lot of retail investors, when they really shouldn't be participating when things are really getting pretty dangerous, but they are in it, right? Ultimately, this is all a game that they set, right? And these cycles can go on for years. You're gonna have a hype cycle that happens for about a few months to a year, and then the thing crashes and everybody leaves, and They flush all these like retail investors and traders out for like a couple of years, and things can always get worse than you originally thought. And the next thing you know, they're gone. And next thing you know, they try to pump stocks again, which is kind of what's happening right now. They've accumulated enough shares from retail's hands, and they're trying to pump them up. And we're right now getting into maybe a little bit more like cautious optimism, whatever. These things go in cycle, but overall the cycle keeps on going up, right? Because ultimately, the global liquidity is going to increase over time, because there is enough growth, innovation, and productivity of the entire financial system, and then also individual companies. If you're investing in good companies, you're also going to have enough growth, innovation, and productivity to go into it. They really can't, like these market makers and these big powerful elites, they really can't manipulate long-term trends. They really can't, because that's where things are going. You have innovation, you have growth, you have increased productivity, and you have things that are just happening more and more efficient over time, and you are going to cause deflationary forces, and the Fed's going to end up printing money to support that, to make sure that, I'm going to talk about it in another post here. This is going to keep going. It's going to keep going on the long term. Great companies, great economies keep on going up, which is why Warren Buffett says don't bet against the U.S. economy, right? But they sure are going to manipulate the short term here whenever they can, to really get you offsides, to get you emotionally uninvested, to make sure that you don't participate, and also to make sure that you participate whenever things look bad, whenever things look really, really good, and they try to use you as like extra liquidity to flush you out, to even maximize the gain on top of just generally price going up over time, to actually try to manipulate you to play cycles and get you really, really screwed, right? Which is why I prefer to look at things in a longer term trend, because they can set a few traps here and there in the short term, but they cannot change the map, and they cannot change where the roads are going. I gotta say, this is my first post, and if you have enough time, I'm gonna talk about what I think about the whole macro fears that have been going on out there as well. And the macro fears, to me, may not be as scary as it is said out there. I've heard about higher for longer for ever since like 2021, the end of 2021, 2022, 2023. I've heard this narrative going on for a very long time. And if you bought into that narrative and don't buy stocks, then I think that would have been a mistake. If you buy into that narrative and you don't buy Bitcoin, then in hindsight, I think it's going to be a mistake. None of this is financial advice, by the way. I'm just kind of sharing thoughts in terms of what I think about the economy, what I think about the market makers, what I think about the scums that are out there, and also what I think about all these macro fears that are being thrown out there again, right? Their higher for longer perspective is happening in the setting that rates has already gone up for like the last couple of months by a lot, and now people are starting to talk about higher for longer again. Like, it almost feels like they want to talk about something when something is to the extreme, which is kind of silly. A lot of people are wondering whether or not we have the double peak inflation. Around the 1970s, we had a double peak inflations for the entire decade, I think from like 68, 69, all the way to like 82 or something like that. You have this like two big giant spikes of inflation, right? And a lot of people are wondering, now that we had a peak of inflation, are we going to have a double peak, right? I think those are very, very different times compared to now. Back then, the economy was run on oil. It was not easy to produce cheap goods in general. This problem was never really solved after the first peak of inflation subsided. And it just kept going for a whole decade, right? Like they printed a bunch of money during that era, especially when they're trying to do like fight in the Vietnam conflict. They spend a lot of money. There's just too much money going on out there. There's a lot of currency speculation. We completely came off of the gold standard. A lot of things were happening at that time that really spiked inflation twice, right? That problem was never really solved after the first one, and then you get a second peak. We have a much faster economy now, and we don't really have the same problems that they're dealing with at that time. So I don't really think that we're going to end up getting the second peak. And the problem was really solved by China opening up in the 80s and flooding the West with cheap goods. It really solved a lot of problem. Whenever you also have issues with oil prices, you're also going to have innovation that happened. Eventually, innovation was able to catch up, and you have improving oil production that solved a lot of these problems, right? Some folks like me, Kevin, keep attributing this to like Paul Volcker, the Fed. They keep raising rates to the sky, to the double digits, and that's why it solved the problem of inflation. Baloney. I don't believe that rates is going to solve problem. I think that rates is a consequence of what's happening with inflation and that they have no choice but to raise rates. I think that's more of a signal rather than a solution, right? So I continue to remain skeptical of the theory that Paul Volcker raised rates up to the sky and is the hero to solve inflation. I think this is more of a reactive move, and it's a part of the signal for a recession, but it's not necessarily a reason why inflation problem is solved. I really think the inflation problem is solved because of two things. One is China opening up in the 80s. You have the economy going, flooded the entire world with cheap goods, and on top of that, I think oil production has gotten better. Now, the inflationary forces that happened in the last few years, I think they're because of three things. One is massive money printing. Second is because of the supply chain shock from COVID. And the third thing is because I do think that a lot of it, and I think I agree with Jeremy here too, I think that the ongoing tariffs against China, which the Biden administration also has not really lifted any of those tariffs, and Trump is trying to talk a little bit more about maybe raising that tariffs, which that would be one thing that I really would worry about. But ongoing tariffs against China that was set in place in late 2018, right? Well, yes, we'd had a significant amount of quantitative tightening since then, right? We had really, if you look at the M2 money supply, it's just been plummeting. And money printing is still resuming right now. They really have changed to buck the trend. They're not tightening really truly anymore. If you look at the M2 money supply, it's been going up again, but it's going back up in a normal pace as opposed to what it was doing during COVID. It's going back to what it was before that, right? It's normalizing. They need to print money to keep the financial system going, right? And it's just normalizing to the usual pace from the past, right? The supply chain shock has also been normalized, right? There are already a lot, like this whole thing happened, they're already trying to utilize AI. There's already a lot of AI algorithms in place to optimize supply chain efficiency for those companies who want to be best at their games. They're using Palantir. It's as simple as that. They're also using crypto, by the way. I think that like when the supply chain crypto that really has like a bunch of partners, it is VeChain. Like they're using these things. They're trying to really optimize supply chain efficiencies, and that's no longer really a big issue anymore. And then on top of that, the effects of tariffs against China has already been normalized. The reason why I say that is because if you talk to companies that have exposure in China, that have factories and things like that in China, they really had the last few years had the opportunity to look elsewhere, to Vietnam, to India, to other Southeast Asian countries to really try to build a factory somewhere else. They have more economic incentives, that have less concern in terms of the tariffs that the U.S. has slapped against them, right? And then on top of that, with all of this inflationary forces being really subsided, on top of that, you're also having a lot of deflationary forces that are also in place currently. And these things are causing major changes as we speak, right? They're not just these speculative ideas. AI, automation, robotics, more transformative use of internet, including, work from home being more accepted, virtual work being more accepted, that really causes significant reduction in costs. Like it really just makes things like people are not getting stuck in traffic for like 2-3 hours a day just because they have to. And people are actually being able to work more efficiently, and they're able to just produce the same, right? And a lot of times you don't even need they figure out that a lot of work doesn't really even need people, right? And a lot of things can be automated, and it's just absolutely incredible what things are happening right now. So all of these are actually going to bring deflationary forces. Throughout history, there are always going to be deflationary forces that force the Fed to have to print money to keep inflation around 2%. Because if you keep on having deflation, if money keeps on getting more and more expensive, that's not going to be good for the poor either, right? You want to have some inflation to really psychologically keep the market up, right? You don't want to just see like deflation. You don't want to see like stock market just keeps on dropping. Like you want to keep inflation around 2% to keep the economy grow. Automobiles, medicines, computers, the internet, cell phones, all of which drastically changed our lives for decades and brought massive deflationary forces that really required the Fed to print money to keep the inflation at 2% and to push the S&P 500 higher over time. I saw a post a few years ago. Somebody was talking about this whole thing is a Ponzi. Like the reason why S&P 500 is going up up to the right is because the Fed keeps printing money. That's the only reason that the S&P 500 is going up higher. Once the Fed stops printing money, and this is not sustainable, blah, blah, blah. Once the Fed stops printing money, the S&P 500 is going to crash. Well, I mean, I don't believe that the reason why S&P 500 is going up, yes, you're right. The reason why S&P 500 is going up is because they keep printing money, because global liquidity keeps on expanding. But there's a reason for that. It's because they're trying to do this to fight deflationary forces. They're not just printing money because they want to print money. They're doing it because they have to fight deflationary forces that's been in place for decades, and it's still happening for decades. Right? I don't think this time's any different. And unless there's something disastrous happen, and I'm not talking about yield curve inversion, I'm not talking about yen carry trade or whatever. I'm talking about something real, like something bad that happens to the world, like a major world conflict, a plague that takes out a huge chunk of the population, aliens coming, abducted humans in mass, like something like that actually changes the world. Or like, let's say if COVID was like a bad thing that killed like 10 or 15% of the population, like something like that. It did make a significant dent on the world, but we were able to push through it, through money printing, through innovation. We did end up getting suffering for it in 2022, but it really wasn't one of these major things, right? Now they're talking about like yield curve inversion, yen carry trade. I just don't believe in like those being that impactful, because they're things that financial instruments can potentially fix. I don't really buy into the notion of that. I see the Fed being one very, very important signal, right? Again, I just want to reiterate that. But I think people give the Fed too much credit. They admitted themselves that they're reactive to the economic conditions and that they are data dependent. That's what they say, right? They're data dependent. So they're not the driving force for the economy. A lot of people are hoping for the Fed to do this or that short term. It's basically like, oh, you need to do this. You need to cut rates because the economy can't grow if you, like, the economy is going to do whatever it wants to do anyway. They're reactive, right? It's basically like asking for a handout from somebody. It won't change the fact if you're poor, you ask for a handout, it won't change the fact that you're poor. If you're rich anyway, you're not going to need the handout. You're not going to ask for a handout because that doesn't change what you are. It's the economy is going to do what it wants to do anyway. I think the Fed is just a part of it. It's a signal, but it's not going to change the course of the economy in a fundamental sense. I just don't really truly believe that. The things that usually crash the market is not because of economic policies per se. It could be if the economic policies allow things to get over leveraged, but it's really because of massive amounts of leverage. Don't get me wrong. As the economy grows, there will always be debt. There will always be leverage. That's just how the economy works, right? When the economy grows, you're going to have increasing in debt, increasing credit. That's how the economy expands. Margin debt will always increase over time as the economy grows. That will always be the case. I'm more talking about the irrationality of insane credit during, for example, the Great Depression. That's what crashed us back then. The massive amount of money printing and ridiculous currency circulation in the 1970s that has really brought down the 70s. The irrational valuation of companies during the dot-com bubble in the 1990s, with companies have PE valuation up insane values when there's like basically shell companies, right? That's not happening. The company right now, you might have high valuation, but they're actually producing things. They have good business models. That's a completely different, point as to what it was back in the late 1990s, right? The massive housing bubble brought on by irresponsible borrowing behavior of house buyers and banks. You have people that just like keep seeing housing prices keep on shooting up. You can't lose, right? It's been going on. Housing is good. It's something concrete. Why don't I like go out there and get like 3 or 4 different loans and buy 3 or 4 different houses that I cannot afford, right? That was happening. It's not happening now. The insane amount of money printing and speculation that happened around the late 2020 and early 2021, we don't have that euphoria anymore. In 2020, a few things had happened, right? Which actually gets me a little bit more bullish on the market. I think it can potentially be more sustainable over the years because a lot of deleveraging has already happened since then. Speculation and hype stocks got completely destroyed, as shown by the ARK fund with Cathie Woods, have already crashed 80%. And currently a bunch of like these hype speculative stocks that came out, the majority of them are still down like 80-90%, if not more. Some of them have already gone bankrupt, right? You have some stronger companies that have recovered, like Shopify, Tesla. You have a few stronger companies that have recovered from all of this. But the majority of them are still very far from their former glory. Like, it's just been deleveraged, and I think the deleveraging is still, happening right now. Large cap companies were extremely bloated. They overhired, and they were not efficient, right? The Nasdaq, the economy tell them this cannot be. We're going to crush the Nasdaq by like 38%. I think that's what it ultimately came out to be around 2022. We're going to crush the Nasdaq 40% to remind you that you need to change your ways. They got leaner. They became more efficient companies, and their EPS and their earnings show that, right? That needed to happen. It needed to deleverage because it was just getting too bloated. Bonds, which was previously thought to be a safe haven, got completely destroyed and got deleveraged. And some banks who over-leveraged on bonds also got destroyed along with it, which is why a couple of those banks failed, because they were just over-leveraged on bonds. Who thought that bonds would have crashed the way they did, right? Who thought that rates were actually going to be higher for longer? Well, they got screwed because they got deleveraged. A lot of people were worried about the great Chinese housing bubble for a very long time. They were worried about it. They're worried about it for decades, right? Because they're always showing these pictures of like the Chinese government building like these big giant complexes in ghost cities, and this is not sustainable. The housing bubble is going to pop. Everybody just wants to buy house. That's all they want to do. And next thing you know, guess what? The housing bubble has popped. And you get Evergrande, really being in trouble. Like the crash has happened. What are the effects on the global economy? What are the effects on the global economy? A lot of people were worried that there's going to be contagion. You remember, like, Meet Kevin, a bunch of people talking about contagion. What has happened? Contrary to popular beliefs at that time, for over a decade, the bubble has popped, and the world apparently is just fine. It can handle this. The world economy can handle this. If anything, I think they're exporting deflation to the U.S. And if anything, I think they're also trying to increase the global liquidity by printing money in China and to support our stock market. Thank you so much. To support Bitcoin. Thank you so much. So I don't know. I mean, like, a lot of people thoughts, or these economists' thoughts are not always the most accurate. I'm just going to leave it as that. Even a lot of stocks that previously thought could do no wrong, like Nike, Target, Pfizer, Hershey's, Celsius, which has been going up and up for a long time, and Enphase, and many others, they've gone through their respective crashes too to deleverage, even when the stock market continues to go higher to the right. Individual stocks can also get deleveraged as well, and a lot of people might be over leveraged on these stocks, and they're getting screwed at some point one way or another, because you just can't over leverage. The reason why things crash is when things get over leveraged, right? So even the price are a lot higher for the overall S&P 500 now compared to 2 years ago, we've gone through deleveraging, and we're still going through deleveraging, and it is likely to sustain higher prices for years to come, with some pretty forgettable corrections along the way, or even crashes. S&P 500 can still crash 10%, 15%, even if another 20% crash at some point. And they would, well, if it's 20%, I think it's going to be pretty memorable because I think the S&P 500 did crash closer like maybe a little over 20% during 2022. But like you're gonna have these crashes like 10, 15, like 10%. It's gonna be pretty forgettable. It's gonna feel absolutely terrible during those time, but it's gonna feel absolutely terrible. The S&P 500 has already crashed 5%, by the way, from the top. So a lot of people only remember what happened over the last 2 or 3 months. I'm here to remind myself of what happened with history, and that macro trends can last longer than what's being said on news media and by some X accounts. I'm just going to leave you with this thought. It's a 30-minute video with me just going through 2 posts and talking a bunch of gibberish. You can listen to it like a podcast. Just, whatever. Or you don't have to listen to it at all if you have different thoughts. You can share it on your X account, or you can share it on your YouTube channel. It's completely fine. I'm just here to share a little bit of an alternative perspective. I'm just here to kind of share some contrarian thoughts, which I have been over the last like 2 years. And it seems like there is a demand for it. So I'm just going to keep doing what I'm doing. Thank you so much for listening, and have a good one. Take care. Bye.